When it comes to trading, we spend so much time analyzing charts, looking at news, trying to figure out the market's next move. But what if the biggest opponent, the most unpredictable factor in your trading, isn't the market at all? What if it's sitting right there between your ears?
I mean, it's the question every single one of us asks, whether you're just starting out or you've been doing this for years. You see a perfect setup, you've got a solid plan, but then when it's time to pull the trigger, something just goes wrong. You second guess yourself, you jump the gun, or you hold on to a losing trade for way too long. Why does something that seems so logical on paper feel so chaotic in the moment?
Well, here's the thing. The fight isn't really with the market. Study after study, like this one looking at traders on the Zerodha platform, shows us that the biggest hurdles are psychological. It's these built-in, well, they're like glitches in our brain, these cognitive biases that turn a perfectly good strategy into a series of really expensive mistakes. And they're incredibly common. Just look at how many people struggle with things like loss aversion and overconfidence.
All right, so let's actually pull back the curtain on these psychological villains, because understanding them is truly the first step to beating them. We're going to start with 3 of the most common biases that can absolutely wreak havoc on your trading account.
Okay, first up is a really big one. Overconfidence. This is that little voice in your head after you've had a few winning trades that goes, hey, I've got this all figured out. It's that feeling that you know a lot more than you actually do, and it pushes you to take on way too much risk or just trade far too often. And when you look at the numbers, man, it's pretty sobering. One study of active traders found that, get this, a staggering 62% believed they could consistently beat the market. But what was the reality? The traders who were the most confident actually had returns that were 11% lower than the average. Why? Mostly because they were overtrading. Their confidence was directly hurting their bottom line. All right, next on the list is something called loss aversion. This is a core part of how our brains are wired. To put it simply, losing $100 just feels way, way worse than the pleasure you get from winning $100. And in trading, this bias makes us do some really irrational things just to avoid taking a loss. And this isn't just a feeling. It has a real measurable cost. The data shows traders would hold on to their losing trades for an average of 47 days, just hoping and praying for a comeback. Now compare that to their winning trades, which they only held for 29 days. Think about that. They were so afraid of realizing a loss that they did the exact opposite of the old trading wisdom. They let their losers run and they cut their winners short. And the third big one? Herd behavior. This is our ancient instinct to just follow the crowd, because we believe there's safety in numbers. And in today's world, oh boy, this is amplified by social media, where a trending stock or a new crypto coin can create this powerful and often really dangerous gravitational pull. This is pretty much the engine that drives FOMO, the fear of missing out. You see everyone online piling into a trade, you don't want to be the one left behind, so you jump in too, without doing any of your own homework. And you know how this story ends, right? It's totally predictable. You end up buying near the top, right as the smart money that got in early is starting to sell. Okay, so we've identified these biases. But how do they actually, show up in our day-to-day trading? These mental glitches don't just stay in our heads. They turn into very specific, very common, and very expensive trading errors. This is where the psychology hits the portfolio. So take a look at this list. Does any of it sound familiar? Chasing the market. That's pure herd behavior. Overtrading? Classic overconfidence. Fighting a really strong trend or ignoring your own risk management rules. That's often loss aversion kicking in, trying to force a losing trade to turn around. Almost every major mistake can be traced back to one of these biases. So, how do we fight back against our own brains? Well, the answer isn't to get rid of emotion. That's impossible. The answer is to build a system that contains it. And the very first step is to stop seeing the market as just random chaos and start seeing it as a place that has structure and these invisible boundaries. And that's where the fundamental concepts of support and resistance come into play. It's actually really simple. Think of support as a price floor, a level where buyers have historically shown up and pushed prices higher. And resistance is the ceiling, where sellers tend to take over and push prices back down. By just identifying these levels on a chart, you're creating an objective map. It's a framework that helps you make decisions based on probability, not on panic. So, okay, once you've got the map, now you need the right tools to actually read the terrain.
This is where we go beyond just the basic structure and we start trying to measure the market's strength, its conviction, its momentum. And one of the most crucial tools, seriously, is volume. It tells you how many people are actually participating in a price move. Think of it this way. A price move on high volume, that's like a goal scored in a packed stadium. It's loud, everyone's involved, it's significant. It shows real conviction. But a move on low volume, that's more like a whisper. It might not be sustainable. Now, two of the most popular tools you'll hear about for this are the MACD and the RSI. The MACD is great for spotting the direction of a trend by looking at moving averages. But let's really zero in on the RSI. Think of the RSI like a speedometer for the market. It measures the speed of price changes to tell you if conditions might be overbought or oversold. But using it the right way is absolutely everything. And this brings us to one of the biggest and honestly most expensive mistakes I see traders make. A new trader sees the RSI pop above 70, they think, aha, it's overbought, time to sell. And then they just watch in horror as the price continues to rocket higher and higher. So why? Why does this happen? The answer is simple, but it's so important. Context is everything. You see, in a flat, sideways market, yeah, an overbought reading can be a decent signal to sell near a resistance level. But in a powerful uptrend, that same overbought reading is actually a confirmation of strong buying momentum. It means the trend is healthy and strong. It's a green light, not a stop sign. The indicator itself doesn't change, but its meaning completely changes based on the market's behavior. All right, so we've got our structure, our support and resistance levels. We've got our momentum tools like the moving averages we talked about. So let's put it all together and look at a classic strategy called the Golden Cross. It's a signal designed specifically to help us identify major shifts in the market's trend, so we can stay on the right side of a big move. See, a huge trend shift, it doesn't just happen instantly. The Golden Cross actually unfolds in these three distinct phases. First, the selling pressure in a downtrend finally starts to dry up. Then you get the main event. The faster 50-day moving average crosses up and over the slower 200-day average. This signals a potential major shift in momentum. And finally, a new uptrend starts to take hold, and those same moving averages begin acting as support levels on any pullbacks. And look, this isn't just some abstract theory. Let's look at some really powerful, real-world examples from right here in the Indian markets. The Nifty 50 index had a golden cross back in June 2020, and it happened right before an incredible 80% rally. More recently, Reliance Industries flashed the same signal in June of 2023, which kicked off a strong move from around 2,350 rupees to over 3,100. These are textbook examples of how this signal works in the real world. So, this brings us full circle right back to where we started. The problem isn't the market, it's our own psychology. The solution, then, is to use objective tools to build a system based on rules, a system that protects us from our own worst impulses. So, what's the takeaway? Here's your playbook, your action plan. First, you have to be self-aware. Know your psychological weak spots. Second, don't just rely on one signal. Use tools like volume and the RSI to confirm what you think you're seeing. Third, and this is so critical, always understand the market's context. And finally, put it all together into a concrete system with clear rules for how you enter, how you exit, and how you manage your risk. Look, at the end of the day, there's no such thing as a perfect strategy. That's not the point. The goal is to have a robust system that you actually trust, one that keeps you disciplined when your own brain is screaming at you to do the wrong thing. It's the framework that saves you from yourself. So I'll leave you with this question. What's yours?